When you're looking at real estate deals, it is so easy to get buried in spreadsheets and a million different numbers. But what if I told you there's one single metric that can tell you more about a deal's health than almost any other? Well, today we're doing a deep dive into that exact number, the DSCR. So what's this one number, this magic bullet that lenders obsess over, and that every single smart investor needs to have in their back pocket? It's called the Debt Service Coverage Ratio, or DSCR for short. And honestly, it's the key to understanding the financial heartbeat of any property. All right, here's the game plan for today. We're going to start with the absolute basics. What even is DSCR? Then we'll break down the number itself, see how it changes depending on the property, and even look beyond the simple formula. After that, we'll connect it to your wallet, how it actually impacts your loan, and we'll finish up by giving you the tools to think just like an underwriter. So, when you boil it all down, what is DSCR really about? Well, at its core, it's all about one thing: a safety buffer. Think of it as the financial cushion that protects a property when things don't go exactly as planned. Okay, the textbook definition is that it's a ratio of a property's net operating income, that's your income after all the operating bills are paid, to its annual debt service, which is just the total of your mortgage payments for the year. But let's simplify that. It's just income divided by debt. That's it. Now, what's fascinating is how this one number tells two totally different stories, depending on who's looking. From the lender's point of view, it's all about risk. They're just asking, is there enough cash coming in to make sure I get paid? But for you, the investor, it's about survival. You're asking, how much can my income drop before I'm in serious trouble? Okay, enough with the theory. Let's make this real. It's time to get our hands dirty and actually run the numbers. This is where the concept really starts to click. First up, we start with the money the property actually makes. Let's say after you've paid all the operating expenses, taxes, insurance, maintenance, all that stuff, your building has a net operating income of a cool $500,000. Next, we look at the biggest check you write every year, the mortgage. Let's assume your total principal and interest payments for the year add up to $400,000. So you do the simple math. Income divided by debt, and boom, you get 1.25. So what does that actually mean? It means that for every single dollar you owe the bank, your property is generating $1.25. That extra 25 cents, that's your breathing room. That's your cushion. But the big question is 1.25 any good? We'll take a look at this. You can see that 1.25 is pretty much the industry standard. It's an acceptable cushion, it'll get the loan approved. But if you can push that number higher, into the healthy or strong categories, say above a 1.3, that's when lenders start getting really interested and offering you better terms. And of course, anything below 1.0 is a massive red flag. That's a deal killer. Now, here's where we get into the nuances, because that 1.25 we just calculated, well, it isn't viewed the same way for every single property. When it comes to DSCR, context is absolutely king. I mean, lenders aren't dumb. They know that different kinds of real estate carry way different levels of risk. A boring, stable apartment building is a completely different animal than a seasonal hotel, right? And you better believe their DSCR requirements are going to reflect that. And this chart shows you exactly what I mean. Look over at multifamily. A lender might be totally cool with a 1.20 DSCR for a solid apartment building. But then you jump over to something more volatile like a hotel, and all of a sudden they're demanding a much bigger safety net, pushing that minimum up to 1.40 or maybe even higher. So you've got the basic calculation down. Perfect. Now it's time to level up. Let's start looking at DSCR the way a professional underwriter does, by peeling back another layer of the onion. There's this saying in the lending world, and it is so true. Not all net operating income is created equal. The number you see on the page is just the start of the story. Any savvy lender or investor is going to immediately start digging into the quality of that income. They're going to put your income stream under a microscope. They're asking questions like, who are these tenants? Are we talking about a Fortune 500 company on a 10-year lease, or a local business with 6 months left? Are a bunch of leases expiring at the same time? Is most of your income coming from just one tenant? The answers tell them if your NOI is rock solid or built on a house of cards. And you also got to remember, DSCR isn't just one static number. There's the in-place DSCR, which is what the property is doing right now. Then the lender creates their own underwritten version, which is always going to be more conservative. And for a property you're planning to fix up, what everyone really cares about is that future stabilized DSCR after all your improvements are done. So why are we geeking out on this so much? Well, here's the payoff. At the end of the day, this number translates directly into dollars and cents. Your DSCR has a massive impact on the kind of loan you can actually get. The connection here is super simple and direct. You show up with a high DSCR, say a 1.50, the lender sees low risk, and they reward you with better terms. We're talking lower interest rates and a higher loan to value, meaning less cash out of your pocket. But if you come in with a low DSCR that's just barely scraping by, they see higher risk, and you're going to pay for it with a higher rate and a bigger down payment. And the impact goes even further than that. With a really strong DSCR, a lender might feel comfortable enough to reduce or even get rid of a personal guarantee, which is huge. That takes you off the hook personally. With a weak DSCR, though, you can bet they'll not only want that guarantee, but they'll probably ask for extra cash reserves and other painful restrictions to protect their investment. All right, let's head into our final section. I want to arm you with the tools you need to analyze any deal like a pro and, more importantly, to avoid the common traps that people fall into. So, as important as DSCR is, just remember it is one piece of a bigger puzzle. Lenders really look at risk through a few key lenses. DSCR is your income cushion, loan to value, or LTV, is your equity cushion, and then there's debt yield, which is another quick stress test for them. A truly fantastic deal is going to look good across all three of these metrics. And please, whatever you do, avoid these classic mistakes. First, remember DSCR is not the same as the actual cash that hits your bank account. It doesn't include big capital improvements. Second, always stress test your numbers. What happens to your DSCR if vacancy ticks up or rates go higher? And third, probably the biggest rookie error, always use net operating income. Never ever gross revenue to start your calculation. Which really brings us to the final thought here. Mastering DSCR isn't just about being able to calculate today's number. It's about building a deal that has an income stream so strong and a debt road so manageable that it can withstand the pressures of tomorrow. So ask yourself that question on every deal you look at, and you'll be on a whole different level.